Morning guys, Joel Frank here, market analyst for YouTrading, and this is the midweek market update. Let's dive straight into it. I think we should start by looking at the S&P 500 because you can pretty much get a good gauge of what has been happening with risk appetite this week, and it's been quite a downbeat week so far. As you can see, these are 4-hour candlesticks, and since the start of the week, we've pretty much pulled back. Like, we had a bit of a rally. Last Friday closed at a fresh record high, but we've been pulling back ever since, really. Why? Well, you can't really pin it on any one specific piece of news, but people are still concerned about Omicron. Like, there's quite a lot of, I might as well say alarmism going on in the UK at the moment. Omicron is spreading very quickly. We've already seen a reintroduction of curbs in the UK. There could be more. And it's just got people worried that what's happening currently in the UK is going to come to the US next. Obviously, Europe has already been under some sort of lockdown for a couple of weeks now. But that was more to do with Delta because they had quite a bad Delta wave. But pandemic concerns persist, which is why we've seen the S&P 500 pull back from above 4,700, and now we're trading in the low 4,600s. But for now, 4,600 support there holding up. You got the 50 DMA there at 4,602. This is a key level, okay, guys. If this breaks, then we could see a bit of a push lower towards those lows we saw earlier on in the month, perhaps the 4,500 level or even lower. What could trigger that? Well, alongside worries about Omicron, people are expecting a very, very hawkish Fed. The Fed is today on Wednesday. They are sort of unanimously expected to speed the pace of their QE taper. But then the focus is also going to be on the guidance for the future path of rate hikes. Okay, so that's going to be, we're going to be looking at the language in the statement. We're going to be listening to what Powell has to say in the post-meeting press conference, and there's the dot plot as well. So how many hikes is the dot plot going to show in 2022? Probably 2. If it showed 3, that'd be very, very hawkish. But yeah, traders basically trying to gauge what the Fed's hiking cycle is going to look like, and a lot of people talking about how there is some upside risk because at the moment, I mean, if you look at the 30-year bond yield in the US, it's at about 1.8%, which kind of implies that people think in the long term the Fed's rate is going to be 1.8%, which some people think these long-term rates are too low. And a hawkish Fed today could see those longer-term rates go higher, which, as we know, does pressure equities, particularly duration-sensitive equities or like the growth stocks, which is mainly tech. Stocks which rely on expectations for future earnings growth for their valuation as opposed to actual current earnings, which they report in their earnings release. But anyway, that's stocks. So hawkish Fed, bit of a risk. Obviously, if they're dovish, then, we could push back on towards 4,700. Why not? People do still love buying the dip. It is still, has still been a great long-term strategy. Crude oil kind of tells a similar story. It's been ebbing lower. Last week we were above 73 for WTI. We challenged that at the start of this week, but we kind of been pulling back ever since. And actually, you can see here in blue, that's the 200-day moving average. We're below that now. And if there is a downturn in risk appetite, could be the Fed that causes that, could be more Omicron concerns. Well, we've got this little trend line that we've kind of been forming, and that could sort of send us back towards these recent lows. Moving on to the dollar. Obviously, dollar in focus. We've got the Fed. We've also had a lot of US data this week. Like yesterday on Tuesday, we had the producer price inflation report. Very, very hot, 9.6% year on year, much higher than expected. That comes after the 6.8% for the CPI. So it's like inflation is super high in the US at the moment, which is why everyone's expecting this hawkish Fed turn. Of course, the labour market's good as well. All of this has been keeping the dollar a buy on dips. You can see it pulls back from a high, and then it trends higher. Then we had a bit of a technical correction out of that trend line. Now we've formed another upwards trend line, and it looks as though you can see repeated attempts at this 96.50 area. 1, 2, 3. That's the December high so far, where it looks as though the dollar does want to push above this. And obviously, like I've been saying, hawkish Fed today could be the catalyst for such a move. We'd then want to see a test just below 97, but yeah, it could really go well beyond that. Obviously, if we are let down, because a lot of people are expecting this hawkish Fed, if it doesn't live up to expectations, then of course we could see it test the bottom of this trend line, and then even if that goes, maybe test these recent lows here around 95.50. But anyway, yeah, guys, literally, Fed tonight, main event of the week, but you got to keep an eye on the ECB, Bank of England, Swiss National Bank, Norges Bank, Central Bank of Turkey. They're literally, and there's more EM banks. They're all deciding interest rates tomorrow, so that's going to be a big day for FX markets anyway. But aside from central banks, the main theme in markets remains Omicron. So I hope you enjoyed the video, and I'll see you all in the next one.